Indranil, good morning. Good to have you with us here. First, your thoughts on the OMO announcement yesterday, Indranil?
Yeah, we have been expecting OMO from the RBI for a very long time. The RBI needs to put in about $30 billion. They've currently put in about $12 billion. So we think that, on balance, they'll put in about $5 billion of OMO more by March.
So this kind of still falls short, what was announced yesterday, but step in the right direction, you say?
Yeah.
What does this do to, you've been calling for rate cuts, right? 50 basis points this year?
We have 25 basis points. We actually expected a rate cut on Tuesday, but now it looks like, it'll get postponed to April 5. But yeah, we think that, there has to be one more rate cut, and we are calling for OMO to offset portfolio outflows.
Okay, kind of fill the gap in. But, many have said that the statement, etc., was hawkish, the onus is on the government. But even last year, the RBI put the onus on the government did not contract the deficit, and the RBI cut post the budget. Do you expect something similar now, this time?
Well, I'm not a fan of intermeeting rate cuts, but clearly, growth is weak, inflation is coming off. So I think there are sufficient conditions for another rate cut.
And it should have, of course, since you were expecting it on Tuesday, you're kind of disappointed. What do you think is keeping the RBI back? The causes are all known, but how do you look at it?
Well, that is for them to say. Maybe they want to wait for the budget, but I thought that given, where growth is and inflation is, they could have cut on Tuesday.
So inflation is 5.5%. Their target is next target is 5% by 17. Is there enough? So what do you think will be the triggers, or what will make the RBI move from 5.5 to 5? The journey from here to March 17, Indranil. Or you think it's going to be just qualitative, subjective considerations? Yes.
I think that, there are going to be three factors which can go either way. For example, do we get a third year of El Nino? That's something that we need to see. If the rains are normal, agflation will collapse. Secondly, what everybody is talking about, the impact of this HRA hike by the 7th Pay Commission. That's again, notional. So inflation may go up, but it's just a notional accounting thing. And finally, where do we, stand on oil? Because suppose oil goes to 50, that will drive up inflation very sharply. But, is oil at 50 better, or oil going from 100 to 105 better? So I think that, the inflation numbers next year will have to be read very carefully, because there are going to be a lot of distortions which could, artificially inflate numbers. But in reality, I think that, given where global growth is, given where our own growth is, the threat from inflation is pretty low.
The budget itself, Indranil, what are the budget's not very far away now, 3 weeks left. What is your perspective? You think?
We expect the finance minister to hold on to 3.9% of GDP. As he has to pay for the 7th Pay Commission, and that's about 0.5% of GDP. And that, in a way, is, I would say, the only trigger that the government has right now to support the economy. Borrowing program, we are looking at 5.5 trillion net terms, including T-bills.
So not contracted, but hold it at last year's level, like what they did last year.
Yeah, contracting the fiscal deficit at this point in time is going to hurt growth even more. So maybe, you don't do 3.9, you do 3.8 or whatever, but, you cannot clearly contract the fiscal deficit without hurting growth at this point in time.
Okay, it's very unlikely that they will expand the deficit. Maybe that is what is needed, but it's very unlikely they'll do it. Without going into the merits and demerits, do you think even if they wanted to do it, they could do it, or it's too late?
No, I mean, it's the finance minister's decision in the budget. The fiscal deficit is like, even at 3.9%, well below the 4.8% average since 2000, and growth is clearly very weak. But I guess, the question is more whether he will retain the previous one or whether he will cut it slightly.
Right. No, I mean, almost, no, I'm saying actually go to say 4.2, 4.3. I know that nobody expects that, but if they realize that, well, we need to maybe pump prime the economy, we are the only ones who can spend, nobody else is. Even if they realize, they come to that conclusion, will the markets allow that? The promise made to the financial market, for example, the RBI, there are external pressures as well, it's the FM's decision, but what do you think? There was a view that they could have done it last year. They still had the tailwind of a relatively new government in power, etc., behind them. Is it too late in the game now to do that?
Well, I think, ultimately the decision is that of the finance minister, and, if this is a step that revives growth, it will be supported by, investors who are invested in growth stocks. See, a lot of the views depend on what you are, playing in the markets. If you're playing, if you're a fixed income investor, you obviously don't want a higher fiscal deficit. If you are an equity investor that's trying to buy consumer stocks, auto stocks, bank stocks, maybe you welcome a higher fiscal deficit. So it's not just one view that you have in the markets. Depends on where you're positioned.
Yeah, no, of course. Got that. There some talk that there could be a fair bit of, there could be some realignment back to spending more on social schemes, rural schemes. Any thoughts there, Indranil?
No, certainly, we do think that the government will have to support rural India because, there's clearly strain in rural India after 2 years of El Nino. And, even now, the Southern Oscillation Index is at least still, close to minus 17. And it has to go all the way to at least 0 by April, May for us to get good rains. So at the time of the budget, one cannot be sure that you will get another good monsoon. So clearly there has to be some succor for rural India in the budget.
Yeah. Thanks very much, Indranil. Good speaking with you as always. Appreciate you coming on this morning. Thank you.